Welcome back to The Deep Dive, your essential shortcut to the critical takeaways from the latest earnings calls. We call this segment Talk Tickers, and today we're diving into a major report from a key player in the geospatial sector. And if you were watching the market the day after this call, you saw, well, one of the most explosive reactions of the season.
That's absolutely right. I mean, this call took place after hours on December 10th, 2025, and the market reaction was just electric. We're not talking about a modest uptick here. We're talking about a stock surge that ultimately moved over 35% in one session.
Wow.
So this wasn't just a slightly positive quarter. It was an emphatic statement about fundamental momentum and a crucially massive, durable, contracted visibility.
So if you sent us this source material, you know exactly why you needed this deep dive. Our mission today is to distill what happened, slow down the tape, and really understand the why behind that reaction. We need to dissect the financials, understand the strategic shifts in defense and AI, and analyze the outlook that justified such a massive vote of confidence.
Okay, let's unpack this. Let's start right at the top line, because the revenue figures were the first indication that management had significantly outperformed.
Oh, completely. Revenue came in at $81.3 million. That absolutely blew past the consensus estimate, which was around $72.0 million.
That is a huge gap. And what's more compelling is the growth rate, 33% year over year. That's an acceleration.
It's a really important distinction. See, in a high-growth sector, growth is expected, but acceleration, that suggests demand is compounding faster than anyone thought. But for investors looking at the quality here, the question is always, are they just buying growth, or is it profitable?
Right. And that brings us to the profitability metrics, which were equally strong, but with a bit of nuance in the fine print. Exactly. On non-GAAP EPS, which, strips out non-cash expenses, they delivered break even, 0.00. That easily beat the expected loss of 4 cents. Now, if you looked at the GAAP EPS, that was a miss at negative 19 cents. But management quickly explained, and I think we'd agree, this was mainly due to non-cash items, not an operational failure.
In fact, operationally, they've hit some serious maturity milestones.
They have. This was the 4th consecutive quarter of adjusted EBITDA profitability, hitting a very strong positive $5.6 million. And even more critically for a capital-intensive space business, they delivered their 3rd straight quarter of positive free cash flow.
And that speaks volumes. It means they've broken that cycle of perpetual reliance on external capital just to keep the lights on.
Right. That move from constant cash burn to consistent free cash flow generation. That is the true maturity milestone, and it's why the market reacted so strongly. But that's only half the story. The numbers that truly captured the durability of this growth are tucked away in the contract visibility metrics.
This is where it gets really interesting.
It does, especially for a subscription-focused B2G business-to-government company. The metrics that matter are backlog and remaining performance obligations, or RPO.
Which is basically how much contracted revenue is just waiting to be recognized.
Exactly. The backlog hit a staggering $734 million. That's a 216% year-over-year increase. RPO followed suit at $672 million, up a massive 361% year-over-year.
361 of PREO growth is. I mean, that's virtually unheard of in this sector. So what does that actually mean for the next few quarters? Does that de-risk the entire business model?
It provides exceptional revenue certainty. It de-risks the short to medium-term trajectory significantly. Management noted that nearly 2/3 of that 61% of backlog and 59% of RPO are contracted for the next 2 years. This isn't a forecast. It's secured, locked-in revenue. It gives you, the investor, a clear signal that this isn't slowing down.
And of course, none of this expansion is possible without a strong balance sheet. The company ended the quarter with what, about $677 million in cash and equivalents?
Yeah.
That's a huge runway.
And that capital position was significantly bolstered by that $460 million convertible note raise back in September. The terms are key here. A very low 0.5% interest rate, a 5-year term, and, critically, dilution protection.
Dilution protection up to a stock price of $184 via something called a capped call.
Right.
Okay, hold on. Let's unpack that jargon for a moment. What does a capped call actually mean for the average person listening?
Sure. A capped call is a sophisticated instrument, but the practical fact is this. The company got cheap capital now, but they also bought insurance against massive dilution if the stock explodes. They essentially paid a premium to cap the strike price, where they'd have to start issuing tons of new stock. So for you, it means even if the stock runs to, say, $150, the company is still protected against dilution until the price hits $184.
It's a signal. It's management saying they believe the long-term potential is far higher than the current price.
Precisely.
That kind of runway lets them aggressively chase these opportunities, which brings us to the source of the revenue acceleration. Where did the $81.3 million actually come from?
The source is unequivocally the defense and intelligence sector. That part of the business saw over 70% year-over-year growth. It is the core engine right now.
70% growth. That's incredible. But this is a hyper-competitive space.
Yeah.
What is making that defense momentum so sticky? What stops a rival from undercutting them?
The stickiness comes from the nature of the contracts. They're shifting toward mission-critical infrastructure, not just one-off data sales. We saw several key expansions. The first major win was the prime contract award under the NGA Lunobi program. That was a $12.8 million initial award.
And for those unfamiliar, NGA is the National Geospatial Intelligence Agency. They are the U.S. government's primary eyes in the sky. Securing a prime contract with them is a massive validation.
It is. This Lunobi program is all about AI-enabled maritime domain awareness. We're talking automated vessel detection and monitoring. It's not static imagery, it's near real-time intelligence. Second, the NRO-EOCL relationship was renewed, and a new framework was put in place for ordering their high-resolution Pelican imagery.
That NRO contract signals something crucial about the government philosophical shift, doesn't it?
It really does. It signals that the U.S. government is increasingly willing to trust commercial providers for mission-critical intelligence. They are leveraging the commercial innovation curve.
And that traction isn't just limited to the U.S. The international picture looks just as strong.
Yes, the international wins solidify it. They highlighted a seven-figure expansion with NATO that was awarded before their pilot program was even finished.
Wait, before it was even completed?
Exactly. Think about that. The pilot was so successful early on that NATO immediately committed more capital. That's the clearest indicator you can get that the customer is seeing serious, actionable results fast.
And this all feeds directly into the AI layer.
It does. If defense is the core engine, the AI layer is the turbocharger that makes that 70% growth sustainable.
So we keep talking about AI. What are the specific moves that are making this growth possible right now?
It boils down to buying expertise. The acquisition of Bedrock Research is strategically vital. Bedrock is an AI solutions company. Instead of building that expertise slowly in-house, they just bought a highly specialized team working exactly at that intersection of remote sensing, AI, and national security. They bought an AI moat.
Now, the commercial side was a bit quieter, partly because of that focus shift and agricultural seasonality. But they did point to some high-value strategic wins.
The AXA contract is the perfect example of their new commercial strategy. They're moving from selling raw data to selling actionable insights. With AXA, they're integrating data for geoclaims processing. So imagine a hurricane hits. Instead of sending out adjusters days later, their data can assess damage almost instantly.
So if I'm an AXA claims adjuster, I don't have to wait. I get an automated report within hours of the event.
Precisely. And crucially, the deal also includes a marketplace agreement. This means they can scale their products across AXA's entire partner network. They're not just selling data to one insurance giant, they're gaining distribution into an entire ecosystem.
Okay, let's pivot to the future roadmap, because they are definitely not resting on these contracts.
Yeah.
They are aggressively executing on the tech that's going to drive the next decade.
They really are. Just days before the earnings call, they launched 2 new high-resolution Pelicans and 36 Super Doves. And management noted, almost matter-of-factly, that they achieved first light, meaning the satellites were operational and sending back images the very next day.
That speed is their single greatest competitive advantage. And to meet future demand, they announced a major move, a new satellite manufacturing facility in Berlin.
The location is a highly strategic choice. That facility will roughly double their Pelican production capacity. But why Berlin? It's specifically to meet growing European demand. Geopolitically, many European nations, spurred by NATO, want their own guaranteed local access to data without relying solely on U.S. infrastructure. Building a factory in Europe makes them a crucial local partner.
Connects the geopolitical strategy right back to the factory floor. But the real long-term optionality, that lies in 2 major strategic projects. Let's start with the OWL Next-Gen monitoring fleet.
Right. The OWL project is slated for a tech demo in late 2026. This is a massive leap for broad area monitoring. We're talking 1-meter class resolution, lower latency, and the key tech here is putting NVIDIA GPUs on board.
Moving the processing power closer to the data source.
Exactly. And speaking of putting powerful computers in space, the most headline-grabbing initiative was Project SunCatcher with Google. This almost sounds like science fiction.
It really does.
This is a funded R&D initiative to put Google TPUs, their specialized AI chips, in space. Prototypes are targeted for early 2027. Management explicitly framed this as a long-term option on a data center in space architecture.
Unpack that. Why is putting Google's AI chips in space so revolutionary?
Well, currently, all the data is collected, beamed down to Earth, processed in massive ground-based data centers, and then the insights are sent out. That creates lag. By putting the processing power, the TPUs, right on the satellite, you can run complex AI models at the source instantaneously and only beam down the answer, not terabytes of raw data.
This sounds incredibly bullish. Record backlog, 70% defense growth, Google-funded R&D. But let's look at the guidance. There's one point of nuance that every careful learner needs to understand. The projected sequential dip in Q4.
That's the single headwind, and it requires scrutiny. The full-year guidance was excellent. Revenue raised to $297 to $301 million, and they now expect a full-year adjusted EBITDA profit of $6 to $8 million. That's a huge milestone.
But when you look at Q4 specifically, it suggests a slowdown.
It does. Guidance calls for Q4 revenue to be slightly lower sequentially, and they're expecting an adjusted EBITDA loss of between $5 and $7 million. After 4 straight quarters of profit, projecting a loss, well, it naturally raises questions.
So we have to challenge this. Is this a subtle demand collapse hidden under the guise of forward investment?
Management was very explicit here. They flagged this dip as tied to an investment cadence choice. They're choosing to take a small operational loss now because they're spending aggressively to ramp up capacity for those massive next-gen contracts.
What are they spending on that causes the dip?
2 key areas. First, partner fees for new revenue, like the Lunobi program. And second, accelerated investments for satellite services contracts and the next-gen fleet build-out. It's a strategic pull-forward investment cycle, not a demand problem. They confidently stated they expect the strong Q4 growth rate to continue into FY27, and they reaffirmed their target of FY27 adjusted EBITDA breakeven or better.
A classic high-growth dilemma.
Yeah.
Sacrifice near-term margin for long-term market dominance.
Exactly. And the market seems to believe them.
Okay, let's wrap with our segment. This is not financial advice. And let's be clear, this is not financial advice. Given that 35% move overnight, the market is already pricing in a huge amount of optimism.
That's the challenge. The market tends to underprice 2 things: secure, multi-year government backlog and massive long-term technical optionality like SunCatcher. The immediate risk is that Q4 EBITDA loss, which might cause some short-term noise.
So what's the outrageous but plausible trade idea here?
We call this the sovereign catalyst volatility hedge. The thesis is that the market still hasn't fully priced in the value of the Google R&D or the stability of that defense backlog. We need a way to capture the upside while hedging the short-term margin uncertainty.
How do you structure that hedge?
First, you go long on the company's high-liquidity convertible note. This gives you a fixed income floor at 0.5% regardless of what the stock does. It's an anchor. It pays you to wait.
Okay, and the high-octane part.
Simultaneously, you purchase a massive out-of-the-money call spread, say between the $25 and $35 strike expiring in late 2027. This captures the massive upside potential without the massive cost. The justification is the expectation that a major European sovereign wealth fund, spurred by the new Berlin facility and strong NATO traction, will make a strategic equity investment in late 2026 or early 2027.
And that strategic investment acts as the catalyst.
Yes. It triggers a second massive stock re-rating toward that $184 capped call protection level. It's betting on geopolitics and technology aligning in 2 years while using the convertible note to hedge against any short-term dips.
A fascinating way to leverage both debt and equity options. What an incredible quarter. The core takeaway here is explosive growth, fueled by AI and defense, all backed by record visibility and aggressive future investment.
Exactly. And the long-term question for you to mull over is this. Considering the scale of Project SunCatcher, which could require thousands of satellites, what kind of capital partners beyond Google will be necessary to execute the vision of putting a data center in space? And how might that influence future partnerships over the next 3 years?
A massive thought to end on, suggesting even the current cash pile might not be enough for that ultimate ambition. Thank you for joining us. Now go continue your own deep dive into the material.